Andrew, thanks very much indeed for joining us. First of all, we got a deal. We're not seeing a rally, though. Why?
Well, I think those ISM numbers the other night were fairly alarming, and also, to borrow a European phrase, a lot of what we're seeing with the US debt numbers does look like a bit of a can-kicking exercise. And really, when you peel away the layers, we are looking at some pretty stringent fiscal tightening coming up over the next couple of years in the US economy as well.
Okay, so this, of course, plays out in another way too. Of course, we may have avoided perhaps a default in the short term or even in the medium term, but it's about a downgrade for US debt. And how likely is that to come from the ratings agencies? And what sort of, if somebody did downgrade them, what would it do?
Yeah, it's an interesting question. It's a really difficult one to give a really precise answer on. Obviously, the rating agencies have set a fairly high benchmark in terms of the amount of debt reduction they want to see in the order of $4 trillion to avoid a downgrade. And it looks unlikely that the US politicians will be able to get anywhere near that number. So you'd have to say it's at least, at very least, a 50-50 proposition that we'll see a downgrade, and potentially even higher. If it does, it will have some implications short term in terms of capital flows, in terms of sentiment. The other issue is longer term. Will it make that much difference if the US isn't rated AAA? Because there's not that many AAA assets out there, and I think ultimately investors will still see US Treasuries as a relatively safe investment.
Now, last time we spoke, you preferred US equities, as you said, US equities over, well, should I say developed world equities over those in emerging markets. Do you still stand by that in light of what's happening in the US?
I think so, and if you look at the relative performance, it's been a bit of a wash over the last 6 months. US and EM have pretty much performed, well, maybe US has underperformed just a little bit relative to EM, but over the past year it's been pretty much line ball. Valuation-wise, there's not a lot to distinguish EM between the US. In fact, the US does look a lot more attractive on a valuation basis, particularly with the pullback. And the one good thing we know about the US economy, amidst all of the other bad things that are going on, is that corporate profitability is pretty strong. The reporting season we're going through right now is coming out relatively well, and the EPS momentum does look reasonably strong. So all in all, of all the equity markets around right now, we still think that the US is probably one of the better ones to be in.
Yeah, and is it because corporate America is making all its money, though, in the Asia-Pacific, for instance, rather than actually in its domestic market?
Well, that's part of the reason, and obviously that weak US dollar is certainly helping, particularly for the offshore earnings of the S&P 500 companies. But we spend a lot of time trying to slice and dice the equity valuation numbers, and whilst you can come up with different views about where the US share market is right now, it's very hard to come up with an opinion that US equity markets are somehow dangerously valued. They're either reasonably valued or showing relatively good value right now. And on that basis, in a world of moderate growth, and at the beginning of the year we were looking for moderately growth combined with moderately okay valuations would lead to moderately all-right equity market returns, and we still think that's the case, and we still think that's most likely to be in the United States.
All right, so what has been happening over there in Washington, D.C., how does it really play out as far as Asia goes? What do you make of Asian company earnings right now, Asian valuations, etc.?
Yeah, and it's Asian, in its own right, Asian valuation doesn't look too bad, but if you compare Asia with the rest of the world, a little bit expensive on price to book, a little bit cheap on price to earnings, so it's a bit of a wash really. And when you look across all the sectors across Asia, it's very hard to find any sectors that stand up well relative to their global counterparts. So there's not a strong valuation case for Asia. It's really been an earnings story, and it's really been a macro story this year. And the story, as we all know, has been about rising inflation and tightening measures. And Asia's sort of that awkward part of the cycle now where you're seeing a lot of indicators suggesting that economic growth is starting to slow, but you've still got the rising inflation and the potential for more tightening. So that macro dynamic is still not all that comforting on Asia. I think there will be a moment to move back into Asia, but right now we're at the latter stage of that macro theme that's been playing against Asia, and I think that's probably still got a little way to play out.